All right, welcome back everyone to Lunch at the Market. We're excited to finally hoist up the green and the yellow with a victory. The Ducks, not so much, right? They fell to Auburn, but it looks like the Packers held up the green and yellow for this year. So, if you're a Steelers fan, I'm sorry. You can watch tomorrow's episode, but for today, we're in the green and the yellow. All right, so let's get to it. We had some questions on our ANF, which is Abercrombie and Fitch. We put a trade out there last week. We bought the January 2012 40-45 call spread. So we got lots of questions. Why so far out? Why'd you pick the levels? All right, so we're going to go through them. Thank you at JZZ. I'm not sure if I'm supposed to say at Jazz or at JZ. I don't know. But at JZZ, right, asked us about it. So here we go. So the first question was, why did we choose the January 40-45 call spread in ANF? Well, for us, it's a probability game, right? Uh, they said, why not do the 45-50 call spread because it's cheaper, therefore greater rate, greater chance for return. Well, the problem there is the closer you get to where the stock's actually trading, the less likely you are to be 100% correct. Whereas we'd rather go down the chain and say, look, if the stock's trading at 52, at the time it was trading at 48, we want to be 40, 45 because essentially all the hard work's done. All we have to do is wait for time value to come out of the contracts, and we have a $5 spread. We paid 3 something for it. It's about a 55% rate of return, rather than take the chance that Abercrombie and Fitch would decline further. In our scenario, if we're long the 40-45 and the stock goes from, it's trading at 52 today. Let's say it loses $7 a share, over 10% of its value, and it trades down to $45. Well, we're still completely in the money, and we still realize 100% of the gain on our trade. So that's the goal. We're going to give up some of the return, I guess you could say, in exchange for a higher probability of return. But still, 55% rate of return is nothing to shake a stick at, so that's why we chose the 40-45 in the money, completely in the money call spread, rather than step it up and go 45-50, right? Because again, the stock had declined all the way to $43 and change, and we're still at break even. Whereas the person who was long the 45.50, if the stock declined to $43 and change, they'd lose 100% of their money, right? So that's how it works. We like going completely in the money and just simply riding out the time, waiting for the time value to be sucked out of the options that were long, and then we have a better opportunity to be right. Okay? So why did we go with January 2012 instead of May of 2011 or something closer? Okay, I'm going to be really clear on this one. When you're long and you're wrong, you lose 100%. That's just simply how options contracts work. If you are long an options contract and the contract finishes out of the money, meaning in this case we're long the 45 in the money call spread. If the stock finishes at $39, we lose 100%. Right? So let's say 5 contracts times $300 is $1,500. If we're wrong and the stock finishes below that level, that 40 level where we're long, we lose all $1,500. So that's why for us, when we're long, we want to be way out on the calendar to give ourselves time to be right. When we're short, we want to be in the front month because we don't want the person on the other side of our trade to have any time whatsoever to be right. If you're long and you're wrong, you lose 100%. So we like to push our trades out on the calendar to give ourselves the highest probability of being right. And then in step 1, we like to go in the money as far as we can where there's still a rate of return, right, to give us, again, the highest probability of being right. Now let's take a look specifically. They asked about May of 2011. Well, the 40-45 call spread will cost you $4.05 for May of 2011. Even if you put on our January 2012 trade today, right now, the 40-45 call spread is only going to cost you $3.40. Okay, so already there's a huge difference in price between the May and the January. Why is January cheaper? Because again, moving it out on the calendar also means that there's a chance that you could be wrong, whereas in May, with the stock already trading at $52, you're pending some kind of big correction, you're going to be right. As far as we see it, the longer that we have, right, and our thesis is that the stock market will continue to rise as earnings come in profitable, okay, that puts time on our side, especially because we're so far in the money. If you did the May contract and you paid $4.05 and the stock stayed above $45 a share, then you'd make 23%. If you went out and made our trade today for January of 2012, you'd make 47%, which is double the rate of return. You'd have to wait longer, but then again, you'd be compensated by that with performance. Our trade, where we put it on, should result in about a 55% rate of return because the stock was trading a sub 50, around $48. And thank you to the Fast Money crew. Guy Adami was on that one. I think Brian Kelly was all over that. So thank you to you guys for pointing out that trade to us, that sub 48 was your level to get long. We did, and it should work out extremely well for us. Okay, third and final. How do you know what do you use to determine the size of your hedge, or how do you know when to hedge? When we do spreads, obviously it's 1-for-1, right? Usually we're sellers of put spreads in the front month. So Deckers is a big spread that we're short. You know, we started that we did it several times in 2011. We did it again starting in January 2011. It did not go our way. We had to roll out, right? How do you know when to hedge? Well, when you do a spread, so in this case we were short the 75 and long the 70, it's a 1-for-1. Right, and you do it as a spread rather than just say, I want to sell naked puts, because your downside is completely, right, you could go to zero, and at $75, you know, that's quite a lot of, you know, $7,500 per put that you're short. So by limiting it to the 70, right, 75, 70, your loss is $500. You already know what your max loss is, and that's your hedge. So the reason we like to do spreads so often is so that we can be hedged 1-for-1. It's a nice, easy way to do that. So for our other trades, take a call spread risk reversal. In a call spread risk reversal, it's a long call spread and then short put. So again, you have that all the way down to zero. If the stock breaks this strike where we're short, then we will go and buy the put $5 lower. Okay, so let's say Deckers. Let's say we were long the 70, 75, and short the 65. If Deckers went to, say, $61, boom, we'd go out and we'd buy that $55 put. So that way we'd have a 60-55 short put spread, which we're extremely comfortable with because we do them all the time. But our discipline says if it approaches that short strike or it breaks it by $5, you've got to go out and buy that put. So your max loss is then limited to the cost of the put that you paid and then the width of the spread that you're short. So in this case, it's $500. Say you had to pay $1,000 for the put because, you know, with the stock careening towards zero, you had to pay up for the put, higher volatility, more likely, right, that it'll be below that. So your max loss is $1,500. Do not wait any longer than $5 if you're hanging out there and you've got a short option, right? If you're naked long a call, naked short a put, please, if it breaks it by $5, admit that you're wrong, go out and buy that hedge and move on with life. In terms of using something like VIX calls, right, we're long 17-21 call spreads for May. We're long May because of sell in May and go away. And then how did we choose the amount of call spreads that we did? Well, whatever you can lose 100% of. Because keep in mind, your hedge is in case you're wrong, which means your portfolio is already leaning a certain way, and so therefore you don't want your hedge to be right, so don't go throwing a ton, you know, don't put 10% of your portfolio in a hedge, because that's a massive loss. Right? The goal of the hedge is to lose 100% of it and be right on your other trades that'll make up the loss on the hedge. If you're right on your hedge, be sure to take it off when it's profitable, because again, even if you look at the worst recessions, you know, 2 years, right, are usually the longest recessions in the stock market. Eventually the stock market comes out of it, so don't hold your hedge forever. If you want to lean in that direction, if you want to lean bearish, then switch your portfolio, right? Take off your hedge. Let's say you're really long, you've got VIX calls, the market rolls over big time. Take your VIX, you know, hedges off, start selling the market short, buying puts, doing long put spreads, selling call spreads, and then hedge to the long side, right? Buy some S&P call spreads or something like that to hedge yourself to the upside. Okay, hope that helps. Thanks for tuning in. Don't forget, America's Favorite Traders is back with Season 2. Jared Levy was on the show last week. It's fabulous. We're already getting great feedback from viewers and listeners who have listened to the America's Favorite Traders episode #1 of Season 2. You can download it for free on iTunes by searching for Magnum Opus Financial or visiting magnumopusfinancial.com and looking for the orange bar across the top that tells you that Season 2 is here. Thanks for tuning in again today. Have a great day, and we'll see you tomorrow.